television channel, when we read newspapers, when we watch television channels, when we listen to fund manager observations, we somehow think we understand markets, but after a while, we get more confused than what we were before. Because we are trying to make some overgeneralized view on markets. First is to understand what drives markets. The next slide. What drives market depends on what time period we're evaluating. If you would like to know what drove markets last week, you can come with 10 different points. And if you'd like to know what is likely to drive the markets tomorrow, next week, it could be a different news, different days. What drives market between 10 o'clock to 11 o'clock could be different than what drives market between now and next week. While what drives market hourly, daily, monthly, sometimes even yearly could be sentiment, what drives market over long period of time is earnings. When we describe markets, whether it is Sensex or Nifty or small cap or mid cap, what are they? They're all collection of stock prices. And what is a stock price? Earnings multiplied by PE multiple. When a stock moves 5% between today and tomorrow, the earnings of this company would not have changed. PE multiple is the change. When a stock moves between 10 o'clock to 11 o'clock, earnings do not change in that 1 hour. PE multiple changes. E multiplied by P divided by E is equal to P. So while the price change in the near term is function of PE multiple, which in turn is a function of sentiment, liquidity, demand supply, FII action, political developments. Over a long period of time, price is a function of earnings. You pick any stock in any sector of any size in any time period longer than 5, 10, 15, 20 years and check how much the share price has grown and check how much that company's earnings per share had grown. If the time period is longer than 10, 20 years, you may find both of them sometimes to the second decimal point. But you can find hundreds of companies whose prices would have moved dramatically different than earnings of the companies in the last few months, maybe last year or two. But you can't find a single company whose earnings have grown 20% per annum last 5 years and share price did not. So, what moves market is different in the time period you evaluate. What is the time period we evaluate? Many of you who have dealt with us would have noticed one clause in the portfolio management agreement we all have, clearly demonstrating what is our target, what is our intent. Is our intent to beat some benchmark? Sadly, no. Is our intent to be the top performing portfolio manager? Certainly not. Our intent is to deliver 3 times 2 in 5 years' time. 3 times in 5 years is about 24% per annum. Whether we achieve 3 times or not, why do we say this clearly in crystal clear English? Is to communicate what is the time period we are looking at to evaluate the performance. Three times in 5 years, which is 24% per annum, is not 24% per annum each year, and it is not 2% per month each year. And therefore, it is important to bear in mind what is the time period we use to evaluate performance. And accordingly, the answer to the question, what moves the market, could be different. Yeah, next. Quite often, you may find fund managers talking about economy, how strong it is, to communicate how likely earnings are likely to move, and then conclude how markets are likely to move, giving an illusion that strong economy means strong earnings means strong stock price performance. You might have noticed in the recent weeks, people talking about earnings decline and therefore stock price decline. Some of you who would have noticed such conversations during COVID time, people would have felt GDP decline and therefore earnings should decline and therefore price should decline. While there is some kind of correlation over 20-30 years, in this slide, you may clearly see periods like 2008 to 2012, Sensex was at same level. To give a precise date, 1st January 2008 to July 2013, Sensex was at the same level. But during that period, GDP of India more than doubled. Similarly, if you see March 20 and March 22, GDP of India more or less at the same level. But Sensex and Nifty had gone up more than almost double. What I'm trying to say is, while there is a long-term correlation between economy of India and earnings growth of corporate India and share price growth, this correlation is not on quarterly basis. And therefore, it will be amateurish to predict GDP of India for this year and next year and conclude earnings of corporate India. And is even more amateurish to predict earnings of India and then determine how Sensex is likely to move. Next slide. In this table, you may find several numbers, but I will just focus on two numbers, returns and risk. If you look at major indices, whether it is large cap Nifty 100 or mid cap, which is Nifty 150, or small caps, which is Nifty 250, or Nifty 500, that includes all the large caps, all the mid caps, all the small caps. How much they delivered over the last 5, 10, 15, 20 years? Around 15% per annum. How much they delivered last year? About 40. When we discuss return, we should also discuss risk. Many times we make obscenely high returns, we overlook risk. Okay, return is expressed as a number. How do you express risk as a number? If you invest in fixed deposit in a bank that pays you 7% interest, your value grows from 100, 107, 114, 121 to 122, compounded at 7% per annum. What is the volatility there? Zero. So it's considered as no risk. On the other hand, when you invest in fixed income instrument, be it a mutual fund or something similar, that doesn't grow 7% each year. Some years we may find them growing -5, +5. Sometimes it may find them growing 10, 15. That may have slightly more volatility than what you will find in a fixed deposit. When you invest in a diversified large cap equity fund, you may find the volatility more than what you will find in a fixed income mutual fund. On the other hand, when you invest in a commodity stock or a single sector stocks, you may find the portfolio volatility a lot more than what you will find in a diversified large cap mutual fund. So, the risk is expressed as volatility. And what is the volatility of Nifty 500 over the last 10, 20 years? Around 20%. What it means is, over a long period of time, these indices could have done 15% per annum, but not that each year they gave 15% per annum. Majority of the times, the actual index return would have been about 22% away from that 15. It would have been 37% in some years and maybe -7% in some years. Majority of the times. Maybe 2/3 of the times in the last 30 years, index return had been about 22% away from 15% line. That's standard deviation. And what was it last year? Almost 10. Basically, the single point I'm trying to communicate to you is the last year markets delivered double the long-term average return at half the long-term average risk. I repeat this point. Last year, markets delivered double the long-term average return at half the long-term average risk. If you give this to a 10th, 11th, 12th standard statistics student, he will conclude, now that we have 20, 30 year series of data, the future return should be lower than long-term average return, or the future volatility risk could be higher than long-term average, or both. While we spend some time in trying to predict the future return, it's important we are conscious of the potential future volatility. Some of you would have noticed over the last 3.5 years, to be very precise, from say 2021, January, till last month, October 1st, 2024, Sensex or Nifty or Nifty 100 or market cap of India did not have even a 5% change in any month. From January 21 till last month beginning, we did not have more than 5% change in any month. So the previous month Sensex was 100, the next month was 104 or 96. And next month, if it was 104, the subsequent month was 108 or 104. We did not have a 5% change in any single month. We might have had one or two volatile days like 4th June, like some days in March. But month to month variation had been lower than 5% since January 21 till last month beginning. What was it in the previous periods? Say if you take calendar year 2020, some of you may remember during COVID, March 2020, index fell 30% in 1 month. If you take years like 2019, 18, 17, 16, each of these years you would have had more than 10% change in 2-3 months out of 12 months. But we have not had even a 5% change in the last 3.5 years. Basically, it's a sign of low volatility. So we have had long periods of low volatility and periods of double the long-term average return, which is unlikely to continue in future, at least at the index level. That's the limited observation from this slide. Next. As I mentioned, if you are trying to predict market directions, index, or portfolio return, we should be, what are they? They are just collection of stock prices. Price, as I mentioned, is a function of earnings and PE multiple. If you are trying to predict a 5-year portfolio return, either you need to predict 5-year portfolio companies' earnings or predict PE multiple because it's a function of these two. Predicting PE multiple is speculation because that's a function of sentiment, demand supply, market liquidity, interest rates, several factors. The earnings, on the other hand, is a function of the company's customers, vendors, suppliers, competition, management. And if we have some circle of competence in tracking few sectors, and you have channel of communication with all stakeholders in such businesses, you have some scientific process to predict some fair range of earnings. But how much ever science you bring to the process, trying to predict PE multiple, could be an element of speculation. So when we say our portfolio is designed to deliver 3 times in 5 years, which is 24%, do we expect that 24% to come from earnings or PE multiple? From earnings. Do earnings of these companies grow 24% each year? They may not. But if they do not grow at 24% per annum over 5 years, and still we expect the portfolio to grow at that rate, then we are partly speculating based on PE expansion. And each one of you would have seen several portfolio review presentations my Chief Investment Officer would have made every June, July through a webinar. And my team makes each time we meet investors one-to-one for portfolio performance review. If some of you have not had that review, please request Mr. Balveer Chawla. He will organize a portfolio review session with our portfolio performance review team. And every presentation that we have made over the last maybe 5-10 years, you may find an explanation of how much of our portfolio return had come from the portfolio company's earnings growth and how much of our portfolio return had come from the PE multiple expansion or contraction. That's important for us to understand, but I find many investors who describe markets last 1 year, oh, index is up 40%, this portfolio is up 50%, this portfolio is up only 30%. Do not ask a simple question, how much of that return had come from the earnings growth and how much of that has come from PE multiple? Because the return we make from the earnings growth stays with us as long as the earnings stays with the companies. But the return that we make from the PE multiple stays with as long as market sentiment stays. And therefore, we should not grudge that the last couple of months markets decline and PE multiples are evaporating fast. But the earnings of the companies that we held in the portfolio haven't evaporated. And that gives us enormous confidence to hold these stocks and probably expect slightly higher return in future. Yeah. This slide you may find all the indices marked to 100, a base of 100 over the last 20 years. Blue line is Sensex and green line is an index of smallest companies, and the red is collection of all, large, medium, small, all put together. What you will find there is in a rising market like 2004, 5, 6, 7, you may find small caps rising the most. But in subsequent market decline like 2008 and 9, you may find small cap falling the most. And eventually, at times of panic, you may find all the indices converging. And the story repeats cycle after cycle. As recent as March 2020, when we had COVID, all the lines you might have observed converged. And in the subsequent rally, small caps have done phenomenally better. But this gives an impression to many investors, of course, to wealth managers also, that small caps have done exceptionally well and large caps haven't. And therefore, they may even suggest that going forward, we should be more in large caps and we should get out of small caps. So in the subsequent few slides, I will explain to you why it may not make sense to overgeneralize whole index into one view. Yes. Today we are in November 2024. If you take the last 3 years, October 21 to October 24, the line graph is how Sensex had moved to be measured with the left-hand side y-axis. Each dot is the return each Sensex company delivered to be measured with the right-hand side y-axis. The red colored dots tell you, totally there are 5. There are 5 Sensex companies whose stock prices in October 24 were lower than their own stock price in October 21. And the green dots are the companies whose stock prices have gone up during this period. And what you will notice from the line graph, which is Sensex, is 100 rupees invested in October 21 had become maybe 120 to 140 range. Does that mean all Sensex companies delivered 40%? Actually, no. There are maybe 4 or 5 Sensex companies that have delivered more than 100%. And there are 4 or 5 Sensex companies had delivered negative returns. And majority of the Sensex companies' returns were around 40%. If you do the same analysis on large caps, the 100 stock large cap index, if you count the number of dots, you will find 100. And what you will notice there is probably there are 11, 12 large caps whose stock prices today are lower than what they were 3 years back. And there are probably 10, 12 large cap whose prices have more than 100%, 200% in the same time period. But if you see them only in small caps, the slide after the next slide, in small caps, you will find complete divergences. They're all over the place. So in the last 3 years, 100 rupees invested in small cap index would have become more than 200. But that doesn't mean all the small caps went up 100%. There are probably 40, 50 small caps whose prices today are lower than what they were 3 years back. And there are more than 40, 50 small caps which have gone up not just 100%. Some have gone up 200, 300, 400%. If you come to the previous slide, which collates all the large caps, mid caps, and small caps, you don't find any pattern. Because in the same 3 years time period, while the BSE 500 could have moved 50, 60%, not all the stocks moved 50, 60%. There are several hundred stocks which are up 100, 200%, and there are several hundred stocks which are down also. And therefore, trying to make one uniform sense of the markets in the last 3 years could have been misleading. And trying to predict this over the next 3 years may not make sense. And trying to say that large caps are cheap and small caps are expensive may also not be a valid inference to make. There is a section of market which are much lower today than what they were 3 years back, and therefore they could be considered as cheap. But that section also has few large caps and quite a few small and mid caps. And there is a section of market which you can say is in bubble zone, having gone up 200, 300, 400% in the last 3 years. And that section also has large caps as well as small and mid caps. Then if we can't categorize based on capitalizations, how do we categorize the market? What else? How else? Yeah, subsequent slide. Today, what we observe is the expensive side of the market. How do you define expensive side? If you take today the top 500 companies, which is anyway 90% of India's market cap, out of these 500 companies, 268 companies' current PE multiple is more than double of their own PE multiple 3 years back. Some of you who have been investing for a while may know we should not look at stock price in isolation and conclude it's expensive or cheap. We should look at the price in relation to earnings of the company. If earnings of the company had grown 20%, and if the price of the stock also has grown 20%, and therefore PE multiple is the same, it cannot be considered as expensive or cheap or fair because PE multiples are same. They are as expensive or as cheap as they were in the previous period. But what we are observing now is 268 out of the top 500 companies, PE multiples itself has doubled. What do we mean by that? If you take a company with 100 crores profit 3 years back and trading at a PE multiple of 10 times, and therefore a market cap of 1,000 crores. Over the last 3 years, how much earnings of the average corporate India had grown? About 17, 18% per annum. For ease of calculation, let's take a round number like 20%. 100 crores profit in our example 3 years back at 20% per annum would have grown 100 to 120, 144, 170 over the last 3 years. And I mentioned the 10 PE multiple 3 years back had doubled, which is now 20. At 20 times 170 crores profit after tax, the market cap would have been 3,400 crores. Effectively, in the last 3 years, earnings had grown from 100 to 170, and market cap has grown from 1,000 to 3,400, which means earnings have grown 70% and share price has grown 240%, is what I mean when I say PE multiples have doubled. If we go and pay 240% higher share price to buy a company whose earnings have grown 70%, it's unfair to expect any future return. which is where more than half of the companies in markets are today. This list, expensive part list of 55 companies, of course, include few companies whose PE multiples were very cheap 3 years back, and thanks to the double in PE multiples are currently fairly priced. But this list also has companies which were fairly priced 3 years back, and thanks to the double in PE multiple have become expensively priced today. And this list also has companies which were expensive 3 years back, and thanks to the double in PE multiple have become bubble zone valuation. That's the first part. The next part, almost 73, 74 out of the top 500 companies, the current PE multiple is not even half of their own PE multiple. Just give me a minute. Thank you. So about 73, 74 out of the top 500 companies, PE multiples have currently are not even half of their own PE multiple 3 years back. They include some famous names like HDFC Bank, Kotak Bank, Bajaj Finance, Lever, Titan, Dabur, Marico. Many of them you would not have seen prices moving. In fact, HDFC Bank, Kotak Bank today are almost at the same price they were 3 years back. Lever last month was almost at the same price it was in March 2020. And Dabur and Marico today are lower than what they were 3 years back. Of course, the earnings of these companies have grown maybe 14, 15, 16%, cumulatively more than 50%. But if the price is equal to earnings multiple PE and price is same and earnings have grown 50%, means PE multiple have fallen 50%. So this list may have few companies which were expensive 3 years back, and thanks to the cut in by half in their PE multiple have become fairly priced now. But this list also has companies which were fairly priced 3 years back and have become very attractive today. Independent of this, the fact is 15% of the companies in markets today, current PE multiple is not even half of their own PE multiple 3 years back. That leaves us with about 180, 185 companies out of the top 500, where current PE multiple is somewhat similar to what they were 3 years back. Famous examples could be stocks like Reliance, or most of the IT companies like Infosys, Wipro, TCS, HCL. How much they all have grown in the last 3 years? About 10, 12% per annum. How much these companies' earnings have grown during the same period? Same 10, 12% per annum, which means their current PE multiple is more or less same as where they were 3 years back. And these are all index dominant stocks. And therefore, what you will find in Sensex and Nifty is they are trading 23 times current year earnings. And what were they 3 years back? 21 times then prevailing earnings. So Sensex and Nifty hasn't turned expensive. But if you go to market to individually invest in stocks, more than half the companies are trading in bubble zone. What kind of companies? Railway stocks, defense engineering, capital goods, infra, metals, real estate, power. Do we have any investment in the first category of stocks? We don't. Be it large cap, mid cap, small cap. Do we have all our investment in the middle category of the market? No. We have only half our money there. And the other half we are in the fair part of the market. Why not we put all the money in the deep value side of the market? That brings us to the other important point we should bear in mind in my next slide. For that, we need to understand who is buying, who is selling. Many of us, when we hear that FIs are selling, DAs are buying, somehow we tend to assume they are selling and buying same stocks, and they are not. When we say that retail is buying, we need to understand who is selling them. Okay. Is retail buying what FIs are selling? No, because both are buying and selling different stocks. For us to understand, we need to understand who holds what. So we are about $5.5 trillion market, and about 53% is owned by promoters. About 16.5, 17 is FIs. 10% mutual funds. About 7% DIIs other than mutual funds that include LIC, insurance companies, provident funds, CPFOs. Retail owns 7. All of us put together, which include family offices, HNIs, NRIs, portfolio managers, that's about 6. This is how equities are owned in India. Why it's a very important number to bear in mind is if you take the last 6 months, the number of companies promoters increased stake is at a 14-year low. On the other hand, number of companies promoters dilute stake is beginning to grow. You don't need statistical evidence, just look at number of IPOs. How many IPOs in March 2020? None. How many IPOs in current quarter? Already reaching all-time high. FIs may own 16, 17% and they're aggressively selling. But how much they have sold in the last 1 month, 2 months, 3 months, 6 months? 10, $20 billion? How much FIs own? They own $900 billion worth of stocks. So what FIs have sold in the last couple of months is 1% of what they own. But what are they selling? They are selling what they own. What they own? 25% of FI investments in India is HDFC Bank and Reliance. 60% of FI investments in India is Nifty 50 companies. 86% of FI investments in India are in top 100 large caps. Is that any different when it comes to DIIs? Actually, no. If you look at the 7% that DIIs own, 82% is in large caps. Is that any different in mutual funds? People who are tracking closely the inflow in the last 1 year may notice that more than 70% of the inflow were in small cap, mid cap funds. But that's not the case in total mutual funds. If you today take the 68 lakh crores AUM mutual fund industry has, out of that almost 37, 38 lakh crores is equities. If you take all the equities held by all the schemes of all the mutual fund AMCs, almost 74% is in large caps, even today. So then who is buying and selling small caps? Retail. Retail is buying, but who is selling? Promoters. Usually these things do not end well. The expensiveness of market is not just market cap weighted, but liquidity of the market is market cap weighted. Okay. Yeah. As I mentioned, the last quarter had seen the lowest promoter buying. If you see the Q3 FY24, Q4, you may notice a 14-year low. Yeah. You might have noticed many of our funds actually underperforming the index last 1 year. Till March 24, maybe we are just in line with index. But many of you who were seen as 2016, 17, 18, 19, 20, you take any 5-year period, 2017 to 22, 18 to 23, 19 to 24, you might have found our accounts doing 3 times in 5 years or less than 5 years. But that's not what you are seeing in the last 1 or 2 or 3 years. Especially in the last 6 months, we might have been almost 10% lower than benchmark. And we are very glad about that. The reason is, if benchmarks are rising, disproportionate to the earnings, should we play to the tune? We should not. If benchmarks are rising because a segment of market is expensive and that expensive side is in the momentum, should we be also playing that momentum? We should not. Maybe we should play that momentum if our intent is to beat the benchmark. If our intent is to deliver 3 times in 5 years, which is focus on absolute return, if a segment of market is turning expensive, we should not be in that part of the market. So as I mentioned, the 55% of the markets which are expensive, which are railway stocks, defense engineering, capital goods, infra, real estate, and power, it is that segment of market where you see extremely high level of momentum. But have you not noticed last 6 weeks that segment of market has fallen the most? How much our portfolios have fallen? Maybe 1.5% in October, maybe 1.5% in the last few weeks. So peak to bottom, peak to current level, when indices are down 10-15%, have you not noticed the section of market is down 20-30%? And our portfolios are down hardly 1-3%. Does that mean we should lift the collar and say, see, index itself is down 10-15, we are down hardly a percent or two? We should not, because our focus is to do 3 times in 5 years. And are we well on our course? Maybe after the presentation, I will ask my colleagues to share the return numbers, which you may find in the subsequent slides. And you may find October 1.8, September 1.5, August 0. And you may find this in the previous year. When index did 40, we might have done 37. But this year, when index is down dramatically, you may still find us not that bad. So what matters to us is the return that we generate over a 5-year period. And we are not hassled by underperformance of the last 1 year. And we are not elated by the outperformance of the last 6 weeks. Okay. And you may find subsequent slides covering about how our portfolio earnings growth continues to be 17-18%, and how our portfolio P is not even 20 times, in spite of the fact that small mid caps are at 30 and 40 PE multiple. These things matter in predicting future return. So instead of me getting into the portfolio metrics and where we see opportunities in terms of India macros, I'm sure you are all already exposed to so many of presentations where people talk about the macro is great and the earnings is great and long term is great. But I don't want to bore you with more statistics. But only one point I will highlight. Today, if you look at our economic growth, 3.5 trillion, touching 4 trillion, market cap already crossing 5 trillion. What is driving the earnings now? What is driving the economy now? Only about 20%, less than 20% of India's GDP is exports. Have they been growing aggressively in the last 2-3 years? While India as a whole is growing 8% in real terms and maybe 11-12% in nominal terms adjusted for inflation, not all segments of Indian economy is growing 12% in nominal terms. Our exports haven't grown. In fact, the share of exports in whole of India has been declining trend. Almost 80% of India's economy is domestic. So we are not that concerned about global slowdown or elections in US. Maybe if you are in IT, pharma, textile, oil and gas kind of businesses, which are sensitive to global economy, one should be concerned and track some of these developments. But 80% of Indian economy is domestic, and therefore it makes sense to focus our attention on what's happening in domestic markets. Out of that 80% in domestic, 20% is government and public infrastructure. 60% is domestic private consumption. And that domestic private consumption, you might have seen the most performing index today, maybe consumption index, because the consumption indices are dominant by companies like Lever, Nestle, Colgate. They are all mass market consumption, which haven't grown anything more than 2-3% per annum in volume terms. But don't you notice 10 times of that number, like 20-30% growth each year in hotels, hospitals, consumer durables, home electricals, kitchen equipments? Because a section of consumption is growing a lot, but consumption index is not reflecting that because it is getting brushed by few large companies which were all in mass market consumption. And that inefficiency in market is what we are trying to make benefit from. And that's a bit contrarian kind of investing. But we are not contrarian for the sake of being contrarian. But if you would like to focus on businesses which you grow, today the challenge is 24% earning growing companies are trading at 40 and 50 PE, which if we buy, we are not going to make any decent return. Instead, it made sense for us to lower our return expectations to 17-18% because we didn't have to overpay for it. On the other hand, in the next 6 to 8 months, you may find volatility coming back. And when markets turn more volatile, small mid caps will turn even more volatile. And when small mid caps turn more volatile, the volumes will turn even more volatile. At that time, you will find us becoming aggressive. If you look at our portfolio in 2017, 18, 19, 20, almost 90-95% of our portfolios were small caps and mid caps. But whole of last year, we kept almost 50% of our portfolio in large liquid names. If you keep a portfolio in ITC, Dr. Reddy, Infosys, HCL Tech kind of stocks, do we expect three times in 5 years in any of them? No way. If we should be happy if we earn 12-13% in that section. Then why did we keep half of our portfolio there? Is anticipating volatility. During volatile times, you can't restructure the portfolio if whole of your portfolio is small cap, mid cap. But if you keep half your money in large liquid names, where your return expectation could be lower, but your access to liquidity will be of tremendous help when volatility resumes. That time you will find us becoming aggressive when whole market is fearful. That's my presentation. Will be happy to take questions. Thanks, Chirag. You can close it up.
Yeah, thanks. So thanks a lot for this. So maybe, if you could just touch upon a bit on where do you see the current economy going, or, at what stage is India poised, and why do you have that conviction that over the next 3-5 years will be a great economy to be invested since? Because you mentioned about domestic consumption, but if you could just throw some light on that, sir.
Yeah. See, our belief is between now and the next 5 years, India will create more shareholders' wealth than what it has created between now and the last 5 years. Okay.
Okay.
But we don't expect that to happen in the same stocks and similar sectors.
Right.
When I began my career in 91, Sensex was full of steel, cement, power, textile. There was not a single IT, pharma, financial. There was no bank in the index in 91.
Right.
But when country grew 3x, 4x by 2001, the same steel, cement, power, textile, which was more than 60% of the index, became less than 20% of the index. Not because they shrink, but because many other sectors grew.
Yeah.
Like IT, pharma, real estate became almost half of the index by 2001. Even then, financial services was hardly 7-8% of the index. But today, financial services may be 38% of Sensex, 36% of Nifty, and 35% of India's market cap. So when our $5 trillion market cap becomes 10 trillion, do we expect financial services to be 35% of the index? May not be. I won't be surprised if it is below 25% of the index. Will IT be like 15% of the index like it is today? Unlikely. Then what is going to take up this place? Will be domestic consumption. People get shocked when I say that India's travel and tourism industry today is larger than Indian IT industry. You may find 5 IT companies in Sensex. You may not find a travel and tourism stock in index because the largest hotel company may still be 2-3% of the hotel industry. It's
Right.
large but fragmented. Therefore, you may not find large companies.
Right.
But when consumption is growing, we need to understand who is consuming. Not the whole India. You may find per capita income at $2,700, but not even 10% of Indians are around the average. 60% of India may be below $700. And
Right.
for whom food is a large part of the consumption, and the inflation in that food would have curtailed any other discretionary spend they could have had. But the richest 20% of India's consumption per capita income may be well above $10,000. And that's where you find significant rise in discretionary consumption. The joker in the pack is the next 20 in the scale of 1 to 100. Basically, households between 25,000 rupees monthly income to below 1 lakh rupees monthly income at the household level. Household of
Right.
4 people, meaning I'm talking about per capita income of 6,000 rupees to 24,000 rupees. That segment is probably the fastest growing income group because that's where women participation workforce has grown. And that's according to us, a beginning of a long-term trend. And there, surprisingly, the consumption share of the income is also rising. A, income is rising. B, consumption share of the income is rising. But that consumption share is not a rise in soaps, detergents, footwear, washing powders kind of thing. But that consumption rise we may find in ACs, washing machines, kind of household items. You may find hotel bookings. You may find hospital admissions. So hospitals going up 5 times in the last 5 years is not a sign that India is becoming sick. It's
Right.
a sign the number of households in India that can avail a private health care has grown, right? When you see Delhi airport surpassing JFK, when you see Delhi airport becoming busier than Changi, it's not that Indians are traveling more. It's more Indians traveling, right? With the crowd you see in restaurants, it's not that Indians are eating out more. It's more Indians eating out. When you see mutual fund SIP is growing, it is not that Indians are investing in more in mutual funds. It's more Indians
Got it.
investing in mutual funds.
Yeah.
So where is this more coming from? That more is not coming from bottom 80. It is coming from the next 20, which is why we might have seen us renaming BCAD as BCAD Breakout 20.
Okay.
And that breakout is not just across few sectors like what we are focusing on. You may find that repercussions across several sectors. And that growth will prompt India's because 62% of India's GDP is domestic consumption. And that consumption is here for real. Yes, sir.
So that comes to the next question. So irrespective of if tomorrow what media says in terms of US could get into a recession or there could be some global turmoil. So we are trying to say that we are insulated to a certain extent from all of this,
About 20% of our economy is exports.
right?
And to that extent, you will have an impact.
Okay,
But are we not giving disproportionate importance to what's happening in US and Europe? Maybe if you're an economy like China or Thailand or Vietnam or Philippines, then 1 minute.
yeah.
So, what is happening in US and geopolitical events is of immense importance to economies like China, which is sensitive to global markets. We are
Right.
not. Example, in 2004, our share of the global trade was 1.9%. And last year, our share of global trade is 2.3%. Whatever growth that we had seen last 20 years did not come from globalization.
Got it.
It came from domestic sources. And therefore, um, we are giving disproportionate importance to what's happening in US and Europe. And I don't think, maybe there are few businesses like IT, pharma, textile, and oil and gas, which are sensitive to what's happening in global markets, but not whole of India. Yeah.
Okay. Okay. So yeah, so typically there were a couple of questions. One was regarding this US, recession, that there is recession and economists are recommending to sit on cash. I think so. You have answered that, and the other part was more on the IT sector. So which again, I think so. You have. So do you feel that IT sector in the near term, how is it going to play out? Any specific thoughts?
I think IT is neither cheap nor expensive.
Okay,
And IT is not a sector where you are going to get earning shock or earning splurge. It's going to be, if the return expectations are 10, 15, that's where the sector had been in the last 3 years, right? That's how it is likely to be in future. But there will maybe several high growth businesses that could come outside some of these sectors. And therefore, their weightage as percentage of India's market cap could decline.
So how
Yeah.
are you seeing, so when we are saying consumer discretionary, or you're saying, discretionary spending at the Indian level is increasing in terms of tourisms or restaurants or the likes of it. How are you seeing these new age companies then? Is there any thought, anything that you are looking at in these companies, or are you still staying away from them?
We are staying away, not because we are bearish about them, but because we don't have the skill set to evaluate them.
Okay,
Having got used to be very um, uh, careful on the price you pay as function of the earnings.
right,
Many of the new age businesses, the concept of earnings do not exist.
right,
You need completely different mindset to evaluate them. Uh,
absolutely.
we are still learning, but not yet found a way to do it.
So we can expect that in the near future, that would be something that you all will be looking at more seriously. How is it?
As some of the companies become matured, it's not that we are waiting for us to get matured. There are certain businesses need to get matured where there is certain cash flows need to be a lot more evident. See, we know we don't need to be a groom in every marriage. We may become a corpse in every funeral. So I think if we play within the circle of competence we have, I think we have decent opportunities. That doesn't mean we will not expand our circle of competence, but we will never invest outside the circle of competence. So we are working hard to expand the circle of competence. For example, um, 10 years back, we had within the circle of competence, you would not have had chemicals.
Right.
But 3, 4 years back, almost 25-30% of our portfolios were chemicals.
Chemicals. Yeah. Yeah.
Like that, you may find our circle of competence enlarging that include some of the um, last mile connectivity names. But today we don't have the skill set to evaluate how the cash flows are going to come. It's not about betting on businesses. We don't think when clients give us money, we are betting on businesses. We don't
Right.
think when clients give us money, we are putting in market. These are all common terminologies you will hear when you invest in new age business.
Right.
We think when you give us money, we are investing in collection of businesses. Our return is a function of the business earnings. And when we express the portfolio in terms of the earnings of the companies we hold, the return on equity of the companies we hold, the leverage these balance sheets have, and then evaluate the price as function of the earnings, and then evaluate PE in relation to the earnings growth. How do you do all this in new age business?
Yeah.
The is negative.
Yeah.
So when you calculate PE where the demand is negative, you get an
Ne-
infinity number.
Yeah.
So you need a different mindset to pursue those businesses, and therefore we avoid for a time being. As you get positive cash flows, you may reevaluate. If they are very expensive by then, we may still avoid. But
Got it.
who knows? Market could give us one leg opportunity little later.
Got it. And one more part, which there is a couple of questions. So one which you have already mentioned, that you're looking at more of the companies or the sectors where the second 20, the 20% is spending money. So that could be maybe tourism, maybe hotels, maybe the likes of it, which is not your toothpaste and shampoos discretionary, but the actually where the lifestyle expenses are happening. Am I
Yes,
correct there? That's where
yes.
you're up finding a good opportunity, and you find
That's
that this could
let's not
expand.
narrow from the whole of Unify in that category, but that's where you will
That's
find
fair.
a little more opportunities.
Got it.
But our circle of competence includes even today chemicals. Even today, you may find retail credit.
Yeah.
You may find that including quite a few manufacturing businesses which aid this growth.
Right.
But it's not we are narrow framing to one sector or one concept.
Understood.
We have at least about 6 or 7 different idea funnel, and our blend Rangoli is a function of 8.
Right.
BCAD you may find 6. Yeah.
Right. And with the, of course, with your portfolio, the way you have built the portfolio, I'm sure you have taken care of situations where the promoters, wherever you don't find the comfort of the promoter, you're not entering into those businesses at all. That is what we have been discussing quite a long time and every time. But do you feel, some news that keeps coming in between of some large names that have just cropped up again and keeps coming up? So does that hurt the sentiment? Of course, it would hurt the sentiment, but again, as you say, it would probably be for a shorter period of time. Am I correct there?
You are right. You are right. The impact of negative news flow on promoter activity could hurt the whole of market in the near term,
Right.
but it will hurt only few companies in the long term. The cost of research in India is inversely proportional to size of company.
Okay.
Small cap research costs more money. So
Right.
our responsibility, we are a team of about 155 people in Unifi. There is
Right.
a 60-member primary research team.
Yeah.
They're spending a large amount in research, and that research is not secondary research. It's not talking to brokers and attending broker conferences and joining con calls and hear what promoters talk.
Right.
But it's primary research in terms of going and meeting companies, their plants, their customers, their vendors, their suppliers, and their competition. And such a research work, it takes little longer time, costs more money, but it gives you a perspective inside out of promoters. If the average age of companies we invest is about 28 years, that's the average today.
Right.
Um, Promoters would have left enough trail over such a long
Such a
period
long
for us
period of
to
time.
validate. But if you invest in businesses which have come out of nowhere, like the specific large name that you are mentioning
Right.
indirectly,
Right.
and I'm referring to the same name, that if some
Yeah.
of these names come out of nowhere in the last 5, 10 years,
Right.
out of some political legacy or something which you cannot explain in clear English, we
Absolutely.
just stay away from them. That's it.
Right. Uh, Thank you, sir. I don't think there is any other question unless you want to
Sincerely
just.
appreciate giving me the opportunity. Um, uh,
There's
we now
one
have a
question,
good
just
team.
one more thing. So when can we expect a new theme coming out of the Unify stable now?
See, we have been working on it, but we don't want to come with the theme for the sake of coming out with the theme. In the
Right.
past, we have come out with the 2, 3 themes in 2, 3 years, but we have not come out with any theme. Actually, last year we shut all the funds for subscription.
Yes. Yes.
Were we bearish in market? Actually, no. We were concerned about the money flow into market. See, our loyalty is to the investor who already has put the money.
Absolutely.
And if any interesting ideas come, we would prioritize that investor who comes in. And in the last uh, 5 years, if you look at how much money we raised from investors, it's been about 100 crores a month.
Right.
But last year that became 500, 600 crores a month.
Right.
And which is why we shut. Because our ideas flow do not grow as much as the cash flow.
Right.
So it is better to shut the fund rather than take more money and dilute the investment processes we follow. But last 2, 3 months we have actually reopened because we are seeing some crack happening in market, some interesting valuations come. But investors are now measuring us in relation to index and conclude underperformance.
Underperformance for the
It's a
last
challenge.
six
When
months,
they
one
were in
year.
a great mood to invest, we were not keen to take. Now we are keen to take, and when investors are not in a mood to invest.
I think
Because
so
then,
that's the paradox. That's the paradox in our business. So whenever we
yeah,
are bullish, investors become bearish, and vice versa. So
true.
when markets are good, we keep telling clients, okay, don't keep it. Either keep it in a balanced fund or just keep it aside for some time. And they say, "Are we are losing out on an opportunity." Whereas now, when we sort of tend to become a little aggressive, they say, "Are, let's wait for another fall or something like that." So I
Exactly,
totally get
exactly.
exactly how it
So we are
works.
confident. We don't think the next 6 months is going to be a rosy, right?
Okay.
Uh, we think the next 6 to 8 months we will see a lot more volatility than what we had seen in the last 3 years. That's
Okay.
precisely a reason we should be investing.
Got it.
As long as we stay with disciplined approach and don't deviate from our own processes, we may underperform index near the peak of the bull market. We may
Right.
outperform the index in bottom of the bear market,
Bottom
but
of
both
it.
doesn't matter. What matters is what is the return we make. Today,
Absolutely.
if the 100 rupees that we take it from clients, are we going to make decent rate of return? The answer is yes.
Right.
So we are confident in reopening, whether investor is in a mood to invest or not. But last 6 months, 1 year, investors were in a great mood to invest, but
Right.
we were not keen to open. But now we are open, and hopefully, if you set up few calls with clients, Chirag runs a team.
Right.
Um, now, and we'll be happy to do one-to-one calls and explain to
Sure.
them where is our excitement coming from.
Sure. Definitely. Definitely.
Thank you. Thank you very
Thank you
much.
so much.
Appreciate giving the
Thanks a
opportunity.
lot for taking out time out and really addressing us. So hope to see you soon in Pune physically, sir.
Look forward.
Yeah.
Pleasure is
Okay.
mine. Thank you, Chirag. Thank you.
Thank you,
Thank you.
sir.
Thank you so much,
Thank you,
Chirag.
Murli, sir.
Thanks a lot.
Thank you.
Thank you so
Thank you.
much.
Good day,
Thanks,
sir.
everybody. Thanks for your participation. Thank you so much.
Thank you.